Everyone thinks the Federal Reserve is in control. They think the people running monetary policy have the tools, the knowledge, and the willingness to navigate any crisis. They think that no matter how bad things get, the Fed will step in, print some money, lower some rates, and everything will be fine. This belief has been reinforced over and over for the past 15 years. Every crisis gets met with stimulus. Every market decline gets reversed by intervention. The Fed they call it the implicit guarantee that the central bank will always bail out the markets. I am here to tell you that this belief is dangerously wrong. There are scenarios, and I believe we are closer to one than most people realize, where the Federal Reserve loses control, where the tools stop working, where intervention makes things worse instead of better. And if you are not prepared for that possibility, you could lose everything you have worked your entire life to build. I have spent my career looking for scenarios that others dismiss as impossible. In the mid-2000s, I saw that the housing market was built on a foundation of fraud and delusion. I bet against it when everyone thought I was crazy. They called me names. My investors demanded their money back. Even my own team doubted me. And then the whole thing collapsed, exactly as I had predicted. I did not get lucky. I saw something that others refused to see because it was too uncomfortable, too disruptive to their worldview, too threatening to their positions. I am seeing something similar now. I am seeing a scenario where the Federal Reserve, despite all its power and all its tools, loses the ability to control the economic and financial situation. And I have positioned my portfolio for that possibility. Today, I am going to share the only 4 stocks I would own if the Fed loses control. These are not speculative bets. These are not lottery tickets. These are carefully selected positions that I believe will protect and grow wealth in a scenario that most investors are completely unprepared for. But before I tell you the stocks, I need to explain what I mean by the Fed losing control. Because if you do not understand the thesis, you will not have the conviction to hold these positions when everyone else is telling you that you are wrong. Let me start by explaining what the Federal Reserve actually does and why its power has limits that most people do not appreciate. The Fed has 2 main tools. First, it can control short-term interest rates by adjusting the federal funds rate. When the economy is weak, it lowers rates to stimulate borrowing and spending. When the economy is overheating, it raises rates to slow things down. Second, it can expand or contract its balance sheet by buying or selling assets, primarily treasury bonds and mortgage-backed securities. When it buys assets, it injects money into the financial system. When it sells assets or lets them mature without reinvesting, it drains money from the system. These tools are powerful, but they have limitations. The first limitation is that the Fed cannot force people to borrow. It can make borrowing cheap by lowering interest rates, but it cannot make businesses invest or consumers spend. If confidence is shattered, if people are afraid of the future, they will not borrow no matter how low rates go. We saw this during the pandemic. The Fed cut rates to 0 and bought trillions in assets, but the economy still contracted because people were afraid. Eventually, fiscal stimulus and vaccines restored confidence, but the Fed alone could not do it. The second limitation is that the Fed cannot lower rates below 0 in any meaningful way. Once rates hit 0, the Fed loses its primary tool. It can do quantitative easing, buying assets to inject money into the system, but the effectiveness of that is debatable. Japan has been doing quantitative easing for decades and still cannot generate sustained growth or inflation. The 0 lower bound is a real constraint on monetary policy. The third limitation, and this is the one that matters most right now, is that the Fed cannot simultaneously fight inflation and support the economy. If inflation is high and the economy is weakening, the Fed faces an impossible choice: raise rates to fight inflation and make the economic weakness worse, or lower rates to support the economy and make inflation worse. This is called stagflation, and it is the scenario where the Fed's tools become largely useless. No matter what they do, they make one problem worse while trying to solve the other. The fourth limitation is that the Fed cannot control fiscal policy. The federal government is running massive deficits, trillions of dollars per year. That deficit spending is inflationary. It pumps money into the economy, and the Fed has no direct control over it. If Congress keeps spending and the Fed tries to fight the resulting inflation by raising rates, the higher rates increase the government's borrowing costs, which increases the deficit, which is inflationary, which requires even higher rates. This is a doom loop that ends very badly. Now, let me explain the specific scenario I am most concerned about, the scenario where I believe the Fed loses control. It starts with a shock, something that causes a sudden economic contraction. It could be a geopolitical event, a financial crisis, a natural disaster, a pandemic, anything that causes a sharp decline in economic activity. In a normal recession, the Fed would respond by cutting rates and buying assets. But here is the problem. We are not starting from a normal position. Inflation is still above the Fed's 2% target. Interest rates are already elevated from the rate hikes of 2022 and 2023. The federal government is already running enormous deficits, and the federal debt is already at levels that make further fiscal stimulus politically difficult and economically risky. If a recession hits in this environment, the Fed faces an impossible choice. If it cuts rates aggressively to support the economy, it risks reigniting inflation. If it keeps rates high to fight inflation, it makes the recession worse. And if Congress responds to the recession with more deficit spending, as it almost certainly will, the inflationary pressure intensifies. This is the scenario where the Fed loses control. Not because it stops trying, but because its tools stop working. It cannot cut rates enough to stimulate the economy without making inflation worse. It cannot keep rates high enough to fight inflation without crushing the economy. It is trapped. And when the market realizes the Fed is trapped, confidence collapses. Asset prices fall. The dollar weakens. Inflation expectations become unanchored, and we enter a period of chaos that could last for years. I do not know if this scenario will happen. I assign it maybe a 25 to 30% probability over the next 3 to 5 years. That might not sound high, but think about what it means. If there is a 1 in 3 or 1 in 4 chance that the financial system experiences a major dislocation, you need to be prepared. You cannot just hope it does not happen. You need to own assets that will protect you if it does. So let me tell you about the 4 stocks I would own if the Fed loses control. These are companies that I believe will not only survive, but potentially thrive in an environment where monetary policy is ineffective and economic chaos reigns. Each one has specific characteristics that make it resilient to the scenario I have described. The first stock is a gold mining company. Now I know what some of you are thinking. Gold miners are speculative, they are volatile, they have terrible management and cost overruns and all sorts of problems, and you are right about many gold miners. But the best gold miners, the ones with low production costs, long reserve lives, and competent management, are one of the best ways to protect yourself in a scenario where the Fed loses control. Here is why. Gold is the ultimate safe haven asset. It has been money for thousands of years. It cannot be printed by central banks. It cannot be debased by politicians. When confidence in fiat currency collapses, gold holds its value or increases in value. We have seen this throughout history. In the 1970s, when inflation raged and the Fed struggled to control it, gold went from $35 an ounce to over $800 in the 2000s. As the Fed responded to crisis after crisis with money printing, gold went from under $300 to nearly $2,000. Gold performs when faith in central banks falters. But owning physical gold has drawbacks, storage costs, insurance costs, transaction costs, and the opportunity cost of holding an asset that produces no income. Gold mining stocks solve some of these problems. A gold miner produces gold, sells it for dollars, and generates profits. When gold prices rise, the miner's profits rise even faster because its production costs are relatively fixed. This creates leverage to the gold price. If gold goes up 50%, a well-run gold miner's stock might go up 100 or 150%. The specific gold miner I like owns some of the highest quality deposits in the world. Its all-in sustaining costs are among the lowest in the industry, well below $1,000 per ounce, which means it remains profitable even if gold prices decline significantly from current levels. It has a strong balance sheet with minimal debt. unlike many miners that have destroyed shareholder value through excessive borrowing and ill-timed acquisitions. This company has been disciplined. It pays a dividend that increases when gold prices rise, sharing the windfall with shareholders rather than hoarding cash or blowing it on empire building. And it has a management team with a track record of disciplined capital allocation. People who understand that their job is to generate returns for shareholders, not to build the biggest company. This is not a speculative junior miner hoping to find gold. I cannot emphasize this enough. The junior miners are lottery tickets. Some will hit, most will fail. The failure rate in junior mining is extraordinary. You might as well go to Vegas? No. What I am recommending is a proven producer with decades of reserves. A company that has been producing gold profitably for many years. A company that will still be producing gold profitably decades from now. The deposits are there, the infrastructure is built, the permits are in place. The only variable is the gold price. Let me explain the leverage in a gold miner, because many people do not understand this. Suppose a gold miner has all-in sustaining costs of $900 per ounce, and gold is trading at $2,000 per ounce. Its profit is $1,100 per ounce. Now suppose gold rises 50% to $3,000 per ounce, its costs are still around $900. Its profit is now $2,100 per ounce. That is nearly a doubling of profits from a 50% increase in gold price. That is leverage. And if gold were to go to $4,000 or $5,000 per ounce, which is not unthinkable in a scenario where the Fed loses control, the profits become extraordinary. In a scenario where the Fed loses control, where inflation surges and confidence in the dollar weakens, gold prices will likely rise substantially. History supports this. In the 1970s, gold rose over 2,000% from its fixed price of $35 to over $800 at the peak. I am not predicting a repeat of that magnitude, but even a more modest increase would generate enormous profits for a well-run gold miner. Its stock price could double or triple or more. It is the ultimate insurance policy against monetary chaos. The second stock is an energy company, specifically an oil and gas producer with low production costs, a strong balance sheet, and a disciplined approach to capital allocation. Energy is essential to modern civilization. No matter what happens to the economy, people need to heat their homes, power their vehicles, and run their businesses. Demand for energy is relatively inelastic, meaning it does not decline much even when prices rise or the economy weakens. In a scenario where the Fed loses control, energy prices are likely to rise for several reasons. First, inflation generally pushes commodity prices higher. Energy is a commodity, so it benefits from inflationary pressures. Second, if the dollar weakens, oil prices rise because oil is priced in dollars. A weaker dollar means you need more dollars to buy the same barrel of oil. Third, energy supply is constrained. Years of underinvestment in exploration and production have limited the ability of the industry to respond to increased demand. New projects take years to develop. You cannot just turn on a spigot and produce more oil. The specific energy company I like is one of the lowest cost producers in North America. It operates primarily in prolific basins where the geology is favorable and the infrastructure is already built. Its break-even price, the oil price at which it starts making money, is among the lowest in the industry. This means it remains profitable even if oil prices fall significantly. But if oil prices rise, which I believe is likely in a scenario where the Fed loses control, its profits explode. This company also has a shareholder-friendly capital allocation policy. It returns a significant portion of its cash flow to shareholders through dividends and buybacks. It is not wasting money on empire building or speculative acquisitions. The management team remembers the disasters of the past when oil companies borrowed heavily to expand at the top of the cycle, only to face bankruptcy when prices collapsed. They have learned from those mistakes. They are running their existing operations efficiently and returning the excess to owners. And it has minimal debt, which is crucial in a crisis scenario. Companies with too much debt can be wiped out even if their underlying business is sound. The debt payments keep coming even when revenues fall. This company can survive anything. It could survive oil at $40 per barrel for years. It would not be thriving at that level, but it would survive. And when prices recover, it would be there to benefit. I want to say more about why I think energy prices are likely to rise in a Fed loses control scenario. The first reason is the dollar. Oil is priced in dollars when the dollar weakens, which it would if the Fed loses control and inflation surges. Oil prices rise in dollar terms even if they remain stable in other currencies. A 20% decline in the dollar means roughly a 20% increase in oil prices, all else equal. The second reason is that inflation lifts all commodity prices. Oil is a commodity when the general price level rises. Oil rises with it. In the 1970s, oil prices went from $3 a barrel to nearly $40 a barrel. Part of that was the OPEC embargo, but part of it was just inflation lifting commodity prices across the board. The third reason is that supply is constrained and will remain constrained for years. The oil industry has dramatically underinvested in exploration and production over the past decade. The shale boom in America masked this for a while. But shale wells deplete quickly. You have to keep drilling just to maintain production, let alone grow it. And the easy, cheap shale has already been drilled. The remaining inventory is more expensive and less productive. Meanwhile, conventional oil development has slowed to a trickle. Major projects take 10 years or more to develop. Nobody is starting those projects now because of uncertainty about future demand due to the energy transition. But the energy transition is going slower than people think, and we are going to need oil for decades to come. The supply-demand balance is going to be tight, and tight markets mean high prices. The fourth reason is geopolitical risk. Much of the world's oil comes from unstable regions: the Middle East, Russia, Venezuela, Nigeria. Any disruption to supply from these regions sends prices higher. And in a world where the Fed has lost control and economic chaos reigns, geopolitical tensions tend to rise. Countries that are struggling economically often do unpredictable things. Wars, sanctions, embargoes, all of these can disrupt oil supply and send prices spiking. The third stock is a defense contractor. This might seem like an odd choice for a portfolio designed to survive the Fed losing control. What does monetary policy have to do with defense? But think about it more carefully. In a scenario where economic chaos reigns, geopolitical tensions tend to rise. Countries that are struggling economically often become more aggressive externally. They look for scapegoats. They engage in saber rattling. Sometimes they start actual conflicts. Defense spending tends to increase during periods of global instability. The United States spends more on defense than the next 10 countries combined. That spending is relatively insulated from economic cycles. When the economy weakens, Congress does not usually cut defense spending. If anything, it increases it to support jobs in defense-dependent districts. Defense contractors have a unique business model where their primary customer is the federal government, and that customer keeps paying even during recessions. The specific defense contractor I like has a diversified portfolio of programs across air, land, sea, space, and cyber domains. It is not dependent on any single program that could be canceled. If one program gets cut, the others continue. It has long-term contracts that provide revenue visibility for years into the future. These are not one-time sales. These are ongoing relationships where the company provides equipment, maintenance, upgrades, and services year after year. Its technologies are critical to national security and would be very difficult for competitors to replicate. These are not commodity products that anyone can make. These are sophisticated systems that require decades of accumulated knowledge and billions of dollars of investment to develop. The barriers to entry are enormous, and it has strong relationships with military leadership that have been built over decades. The military does not like to switch suppliers. New suppliers mean new risks. Existing suppliers know the requirements, know the processes, know the people. That creates a sticky customer relationship that persists through economic cycles and political changes. Republican or Democrat, the military still needs weapon systems, and this company still provides them. In a scenario where the Fed loses control and global instability increases, this company's revenues are likely to grow. Governments around the world will spend more on defense as they face more threats and more uncertainty. The United States will spend more to maintain its technological edge, and to reassure allies. NATO countries will spend more as they face threats from Russia and elsewhere. Asian allies will spend more as they face threats from China, and this company will be a primary beneficiary of all of that spending. Its stock might not double or triple like the gold miner in a crisis scenario, but it will provide steady, reliable growth during a period when most other stocks are collapsing. It is an anchor for the portfolio when your gold miner is swinging 30% up and down, when your energy stock is gyrating with oil prices. The defense contractor will be there providing stability. That stability has value. It helps you sleep at night, it helps you avoid panic selling, it keeps you in the game when others are capitulating. The fourth stock is a consumer staples company. Specifically, a company that sells essential products that people need, regardless of economic conditions. Food, beverages, household products, personal care items. These are things that people buy even during recessions, even during depressions, even during periods of extreme economic stress. Demand is inelastic because the products are necessities, not luxuries. Consumer staples companies also have pricing power in inflationary environments. When input costs rise, they can pass those increases on to consumers because consumers have no choice but to keep buying. You might trade down from name brand to store brand, but you are still buying food and toothpaste and laundry detergent. The companies that own the strongest brands can maintain their margins even as costs rise. The specific consumer staples company I like owns some of the most recognized brands in the world. These brands have been built over decades through billions of dollars of advertising and distribution investments. They have strong market positions in their categories. Consumers trust them and remain loyal to them even when cheaper alternatives are available. That brand loyalty translates into pricing power, which translates into stable earnings. This company also has a global footprint that provides diversification. If the U.S. economy struggles, it still earns revenue from Europe, Asia, Latin America, and other regions. Its products are sold in virtually every country on Earth. This geographic diversification provides some protection against country-specific problems. If America is in crisis, Europe might be doing better. If developed markets are struggling, emerging markets might be growing. The company captures revenue from all of these sources, smoothing out the volatility that comes from being concentrated in any single market. The company also generates strong free cash flow that funds dividends and share buybacks. It has raised its dividend for decades, providing shareholders with a growing income stream that helps offset inflation. In a scenario where prices are rising rapidly, that growing dividend is valuable. It helps maintain your purchasing power, and the company's pricing power means it can continue raising that dividend even as inflation erodes the value of money. And like the other stocks in this portfolio, this company has a strong balance sheet with manageable debt levels. It can weather a storm. It will not be forced into distressed sales or dilutive equity offerings. It will come out the other side intact and probably stronger, as weaker competitors fail and it picks up market share. This is a company that has survived world wars, depressions, financial crises, and pandemics. It will survive whatever the Fed losing control throws at it. Now let me explain why these four stocks together form a coherent portfolio for a scenario where the Fed loses control. Each one addresses a different aspect of the crisis scenario. The gold miner protects against currency debasement and loss of confidence in fiat money. If the dollar weakens and inflation surges, gold will rise, and the gold miner will generate enormous profits. The energy company protects against commodity inflation and provides exposure to an essential good that people need regardless of economic conditions. It also benefits from dollar weakness since oil is priced in dollars. The defense contractor provides stability and growth regardless of economic conditions, because defense spending is driven by geopolitics, not economics. In a more unstable world, defense spending rises. The consumer staples company provides stability and defensive characteristics, because people keep buying essential products regardless of what the economy is doing. Its pricing power protects margins during inflationary periods together. These four stocks provide exposure to hard assets, essential goods, government spending, and consumer necessities. They are not correlated with each other, So if one thesis does not play out, the others can still protect you. And they are all companies with strong balance sheets that can survive a prolonged crisis. I want to be clear about something. This is not a portfolio designed to maximize returns in normal times. If the Fed maintains control, if we have a soft landing, if everything works out fine, this portfolio will probably underperform the S&P 500. The gold miner might be flat or down, the energy company might struggle if oil prices fall. The defense contractor and consumer staples company will be fine but unexciting. This is a portfolio designed to protect you in a scenario that most people are not prepared for. It is insurance. You do not buy fire insurance because you expect your house to burn down. You buy it because if your house does burn down, the consequences are catastrophic and you need protection. This portfolio is fire insurance for your wealth. It protects you against a scenario where the Fed loses control and the financial system experiences a major dislocation. Let me also address what I am not recommending. I am not recommending you put all your money in these 4 stocks. That would be crazy. I am suggesting that you allocate a portion of your portfolio, maybe 10 to 20% depending on your risk tolerance and time horizon, to these or similar positions. This provides insurance while still allowing you to participate in normal market returns with the rest of your portfolio. I am also not recommending that you try to time this. Do not wait for the crisis to start before buying these stocks. By the time it is obvious that the Fed has lost control, these stocks will have already moved. Gold will have already spiked. Energy prices will have already risen. You need to own the insurance before the house catches fire, not after. Now, let me share some additional thoughts on why I believe the probability of the Fed losing control has increased in recent years. The first reason is the federal debt. The United States now owes over $34 trillion. The interest on that debt is now one of the largest line items in the federal budget, approaching $1 trillion per year. And that interest cost rises when the Fed raises rates to fight inflation. This creates a doom loop where fighting inflation makes the debt problem worse, which is itself inflationary. The second reason is the structural inflation we are seeing in the economy. This is not just about too much money chasing too few goods. This is about deglobalization, reshoring of manufacturing, energy transition costs, aging demographics, and persistent labor shortages. These are inflationary forces that monetary policy cannot address. The Fed can raise rates all it wants, but it cannot solve supply chain problems or demographic trends. The third reason is the loss of fiscal discipline in Washington. Neither party is willing to cut spending or raise taxes enough to balance the budget. Deficits of $1 to $2 trillion per year are now considered normal. And when the next recession comes, those deficits will explode to $3 or $4 trillion or more as tax revenues fall and automatic stabilizers kick in. The Fed will be forced to monetize some of that debt, which is inflationary. The fourth reason is the increasing frequency of crises that require government intervention. We had the financial crisis, then the pandemic, then the bank failures of 2023. Each crisis leads to more intervention, more stimulus, more debt. The system is becoming more fragile, not more resilient. And each intervention creates moral hazard that encourages more risk-taking, which sets up the next crisis. I do not know when the system will break. It could be next year or it could be 10 years from now. But I believe the trajectory is clear. The imbalances are building, the constraints are tightening, the probability of a scenario where the Fed loses control is increasing over time. And the prudent thing to do is to prepare for that possibility. Now, while you still can, let me close with a thought about psychological preparation. Because owning the right stocks is only part of the equation. You also need the mental fortitude to hold them when things get scary. In a scenario where the Fed loses control, markets will be chaotic. Stocks will swing wildly day to day. The news will be terrifying. Experts will predict the end of the world. Your friends and family will tell you to sell everything and hide in cash. You need to be able to tune out the noise and stick with your plan. That is hard. It requires conviction in your thesis. It requires understanding why you own what you own. It requires the emotional discipline to ignore short-term volatility and focus on long-term protection. Most people cannot do this. Most people panic at the worst possible time and sell at the bottom. Do not be most people. The positions I have described are not going to be comfortable to hold during a crisis. Gold miners are volatile. Energy stocks swing with oil prices. Even the more stable names like the defense contractor and consumer staples company will see their stocks decline in a broad market sell-off. But if the underlying thesis is correct, if the Fed has truly lost control, these stocks will recover. And then some, you just need to have the conviction to hold on. I have been through this before. In 2008, when my bets against housing were finally paying off, it was not a celebration. It was terrifying. The financial system was collapsing. Nobody knew how bad it would get, even though I was right. The experience was harrowing. Preparing for the Fed to lose control is similar. If I am right, there will be no joy in it. There will only be relief that I was prepared and grief for those who were not. So those are the 4 stocks I would own if the Fed loses control. A gold miner for protection against currency debasement, an energy company for exposure to essential commodities, a defense contractor for stability during geopolitical instability, and a consumer staples company for defensive characteristics and pricing power. Together, they form a portfolio designed to survive and even thrive during a scenario that most investors are completely unprepared for. I hope I am wrong. I hope the Fed maintains control. I hope we navigate the current challenges and return to stable growth with low inflation. But hope is not a strategy. Preparation is a strategy. And these 4 stocks are how I am preparing for a scenario that I believe has a meaningful probability of occurring. What you do with this information is up to you, but at least now you know what I am thinking and why.